So you figure on that one property, that's, what is that, $266,000 in short life assets. So all of a sudden, $1 million acquisition, year one, can spin off that $266,000 plus an additional $50,000 for the furniture. So $316,000 on one property. So now maybe they make that though. I mean, these short-term rentals can make a ton of money.
Most real estate investors are overpaying on taxes by tens of thousands of dollars every single year, and they have no idea it's happening. Today's guest has been fixing that problem since 2002. What he's about to share could change the way you think about every property you own. Let's get into it. Welcome back to Real Estate Roundtable. I'm your host, Lancelot Lenard with the Sir Lancelot Group, serving buyers, sellers, and investors across Central Florida. On this show, we sit down with the people who are actually in the trenches of real estate, doing deals, building wealth, and making the strategies work in the real world. Today, we are talking about money, specifically the money you may be leaving on the table every single tax year as a real estate investor. There is a strategy called cost segregation that has been around for decades, used by large developers and sophisticated investors. But most everyday investors have never heard of it. My guest today has spent over 2 decades making this strategy accessible, and he's going to break it all down for us. Stay with me. My guest today started his career in 2002, the year most of us were still figuring out email. While the real estate industry was busy chasing transactions, he was quietly learning a corner of the tax code that most investors and, frankly, most CPAs had never touched. Over the next 2 decades, he would go on to oversee thousands of cost segregation studies for everything from single-family rentals to sprawling senior living facilities. He is a member of the American Society of Cost Segregation Professionals and the founder of Cost Seg RX, a Sarasota-based firm that has made it their mission to help real estate investors stop overpaying on taxes. He also hosts his own podcast, The Real Estate Explainer, where he breaks down complex tax and depreciation strategies in plain English. If you have ever started at a tax return and wondered whether you are doing this right, this episode is for you. Please welcome Brian Kiczula.
Hey, thanks for having me on the podcast today. I'm excited to be here.
Hey, Brian, let's start with the problem. What is the biggest tax mistake real estate investors are making right now?
Well, I would say not doing a cost segregation study, but a little bit more in depth on that. It's not looking at their land allocations correctly. It's letting their CPA or tax preparer dive in and make that allocation for them.
Is this something that applies to new investors, experienced ones, or both?
Across the board.
What does it actually look like in dollar terms? What is the average investor potentially losing?
Well, land is a non-depreciable asset, so you have to back it out of the basis of your property after you acquire it. And if you go off a wrong land allocation and you're taking away 30% of a depreciable asset when maybe it should be 20%, you're losing 10% in depreciation on that total asset. So depending on the size of your investment, it could be significant.
Why do so many investors overpay on taxes without even realizing it? Is this a lack of education, or are CPAs actually missing this too?
I'd say historically, cost segregation studies have been very expensive to complete. So smaller residential investors it was really never on their radar. Same thing with their tax preparers. It wasn't something that they've looked at. In addition, if you're a tax preparer taking a property over 27 and a half years or 30 years, 39 years of straight line depreciation is really an easy way to go. And if you have hundreds and hundreds of clients, that's usually the way that you're going to depreciate your property.
Is this a failure of the tax system, the advisors, or just a knowledge gap?
I would say it's a knowledge gap. It's just a little bit more complicated of a strategy. So it's really understanding that it's available to not just the large investors, but it's really open to everybody.
Have you seen situations where even experienced investors were shocked by what they had missed?
Oh, all the time. We do look back studies. So we can do studies, or we do studies on same year acquisitions, but we can also do look back studies on properties that investors have acquired years ago and pull forward missed depreciation. So there's, large investors that come to us all the time, and, they never heard of it, to be honest with you. So new strategy for them.
That's awesome that you're doing that. You've been doing this since 2002, if I'm correct. Walk me back to the beginning. How did you even find this corner of the tax code, and what did you see that made you think this is going to be my life's work?
So in the reality, I've been in the real property business since 2002, licensed real estate agent, broker, mortgage broker for a long time. Transitioned into cost segregation after really it was a health issue popped up. I had to step back, had a serious health issue come up, had to stop working for about a year. And when I decided to step back into the market, I was scratching my head, what am I going to do? Because it's what are you going to do? Are you going to go back and do the same thing? The answer was no. So I decided to jump in and start doing tax returns and tax prep. Quickly realized that wasn't something that I liked to do, but cost segregation kind of was the perfect blend of the real property business or real estate background that I have. And I was just able to marry my skill sets. I mean, I'd say that nobody grows up saying, hey, I'm going to be a cost segregation specialist. It's just not something that you know about. So.
For sure. I would agree with that. Everybody wants to be a pilot or fireman or a nurse.
Or a fire truck.
Yeah, or a fire truck. Yeah, or I'm a dinosaur.
Totally.
Was there a specific moment, a client, a number, a deal that confirmed you were onto something?
I just love the idea that it scales. So it's something that smaller investors can take advantage of, as well as the larger investors. I've had clients that buy primarily, they'll buy small residential properties, and they've been turned down by a lot of cost segregation firms who said, hey, the project's too small. It's not really, doesn't meet our minimum, or they've got minimum cost of, let's say, $3,000 or $5,000 to do the study. And the reality of these properties might be $200,000 or $300,000. So they're not going to spend, $5,000 to do a cost segregation study. The ROI just wouldn't be there. But when I realized, hey, I could provide a high level of service for smaller investors, and it works for them the same way as it works for my clients that are buying hotels or shopping centers across the country. So that was it. It's when I realized, hey, the market's a lot bigger than you would initially think. So.
For someone who has never heard this term, what exactly is cost segregation? Give us the plain English version.
Yeah, so basically for a living, I count light bulbs. So that's what I tell my wife, because she doesn't really understand what I do. But really, when you're looking at a property, whether it's residential or commercial, the first thing that we're going to do is look at the exterior of the building. What are your site improvements? What landscaping do you have? What type of driveways or roads do you have? Do you have fencing? Do you have swimming pools, tennis courts, pickleball courts, site poles? What do you have that's exterior of the footprint of the building? And really that's going to be your 15-year asset. So not all of it, but we're going to pull forward a majority of those assets and reclassify them as 15-year assets. And then once you go into the building, we're looking for items that are, let's say, an accessory to the business, or they're in general short life assets. So think removable flooring covers, think your carpet. Carpet is not a 27.5-year asset. It's not a 39-year asset. Same thing with your appliances, your window treatments, and a number of other items inside the building. And we reclassify those items as 5-year assets. Now with the One Big Beautiful Bill Act, you can now pull forward 100% of those short life assets. So if we're able to carve out 15 or 20% of your basis on your property, and you can take that in year one, it's really powerful. So you're able to really accelerate a lot of the short life assets and offset taxable income. So your depreciation is helping you offset that taxable income. And really that's what we're talking about. That's the benefit to the investor.
So instead of depreciating the whole building over 39 years, you are breaking it down into components that depreciate faster. Is that the core idea?
I would say, I mean, depreciate faster sometimes, but not always. I mean, exterior, your roads, you could argue that they're going to be there for, 100 years, but the reality is they do require additional maintenance over the years. So the IRS does allow you to depreciate them on a shorter method. So yeah.
And how is this different from the standard depreciation that most investors are already taking on their properties?
Well, 39 years is a long time to recoup an asset. So if you're going in and you're spending $1 million or $2 million or $10 million to either acquire or build out a facility, and you're expecting to depreciate that asset over 39 years, that is a long payback period. You're outlaying a lot of money up front. Really, what the intent is, it's to stimulate the economy. So now the IRS or Congress has come in and said, hey, on some of these items, you can accelerate that depreciation. On the items that, do have shorter tax lives. So you can pull forward all of that. And, it's really beneficial because now we're seeing, especially on commercial property, where, you can, take advantage of qualified improvement property, which is a 15-year asset. If you're doing interior improvements, non-structural improvements to a commercial building, and it just really incentivizes investors to reinvest in the communities that they own real estate. So.
Gotcha. Most investors know about the 27.5-year depreciation schedule for residential property. Where does cost segregation fit into that picture?
So we have to go in, and what we do is like I said, I count light bulbs for a living. So I literally go in and we're doing construction cost estimating on all these properties and figuring out what is each component in that property worth. And then we're not accelerating it, but we're dividing it into its individual assets. So the 27.5 or 39-year property, it's always going to be your structural components of a building. And I talk to clients about this all the time. I mean, your foundation, your slab, your mono slab, your walls, your openings, so doors, windows, your roof, your primary electrical, plumbing, HVAC, hot water, all of those items are always going to be straight line depreciation. But then we look at everything else and we say, okay, well, how can we segregate these other assets into short lives? Think again, your appliances. So think your refrigerator. Behind your refrigerator, you have an outlet. The only reason that outlet is there is to service that refrigerator. So we can even take that outlet all the way back to the panel box and accelerate that bit of Romex and break that out. So it follows the same tax life as the appliance that it's servicing. It is a dedicated outlet. So cost segregation, we're breaking it out into individual assets.
Does doing a cost segregation study change or replace your regular depreciation, or does it layer on top of it?
Add layers on top of it. So you're still going to have, let's say, 80% of your building or more in your straight line depreciation method, but then we'll be able to carve out flooring, fixtures, window treatments, appliances, and we'll just break it down into individual cost component groups.
So why does this strategy still fly under the radar for so many investors? If it is this powerful, why isn't everyone doing it?
Well, you have to look at, the type of income you're generating. Residential real estate typically is always going to be passive in nature. Even if it's not passive, meaning every weekend you're fixing something, the IRS still classifies that as passive income because it's residential real estate. So if you don't need that additional depreciation to offset the passive income, you may not want to pay the money, or you're not going to have the ROI for doing a cost segregation study. But all of a sudden, if you have active income that you're trying to offset, then I would say anybody that has active income really needs to look at it if they meet the real estate professional status, that's one, or if they're in a business activity. So think about the individual that owns and operates an Airbnb, or the individual that owns a dentist office and he's the dentist that works out of it, or the doctor, or the car wash. Car washes are amazing opportunities. There's a special carve out in the IRS tax, guides that allow you to depreciate different assets differently, and car wash is one of them.
That's good to know. That's why people are so hot about car washes now. Everybody wants to.
That's why they're all over the place. Yes.
Imagine when I was a kid, I had to wash my dad's car. I was like, I don't ever want to do this when I'm an adult. And now, like, at the ripe age of 38. I would love to own a car wash though.
Oh, I worked at Images Car Wash in Orlando when I was a kid going to high school, and I loved it because I got to drive everything, police cars, Lotuses, Rolls Royces, whatever came in. It was so much fun, just blasting the car around the corner. So car washes, yeah.
Getting back to that previous question, is there a misconception about who this is for? Like people think it is only for large commercial deals.
So I encourage everybody to give me a call. So, they could go to the website, Cost Seg RX, jump on and request an estimate of benefit, book a call. And the reason is because I don't know what you're trying to accomplish tax wise. I don't know if you're trying to, if you have a lot of passive income, it's a perfect fit for you. Or if you have a lot of active income that you can offset, it's a perfect fit. So we work up the estimate of benefits, no cost. Say, take it back to your CPA, your tax preparer, have them look at it. If it makes sense for your scenario, then let's move forward and do the study. There's no rush. And I always encourage clients, if you call during tax season, we're at the tail end of it or really the middle of it. Just know that, wait times are going to be a little bit longer, whether you're talking to me or you're talking to your tax preparer. So I always encourage clients, as soon as you buy the property, get an estimate on a cost segregation study, book a call with your tax preparer, and see if it works for you.
And what role does the CPA community play in either spreading or limiting awareness of this?
Well, they do both. They'll definitely, we're seeing a lot more CPAs promote cost segregation and bring it in as, we're a referral source for a lot of CPA and tax preparer partners across the country because it's not a service that they can do. Some CPAs are doing it in-house. They're using automated platforms or modeling type platforms or maybe a software program, but it's not their expertise. So they don't have construction cost engineers on staff that are reviewing it. So I would say that, CPAs are, they're my best source of referrals. So, they just keep doing what they're doing, keep referring business.
So let's talk about who this is actually for. Give me a picture of the ideal candidate for a cost segregation study.
Yeah, I would say if you're a real estate professional and you own property, 100%, no questions asked. Or if you're a high net worth or a high W-2 earner and you have a spouse who's a real estate professional and you own rental properties, there's no question about it. If you own Airbnb product or Airbnb properties, another great opportunity. So anybody who's really, a real estate investor, I say should reach out. If you are a real estate investor and you have 2 or 3 properties, but you're not generating any income that needs to be offset, or if your primary source of income, let's say, is just so low that you're not getting taxed on it, then I don't recommend that you do the study. And that's the benefit of getting a free estimate. We're going to work up that estimate and say, take it back to your CPA, have them, look at it, make sure it makes sense. This isn't like, I always tell people we're not in a today business. It's like you might be in a rush, but we're in a rush or we're not in a rush. We're really, our most important thing is to make sure that we're generating accurate data and we're providing tax savings to our clients. So it's really spending that extra little bit of time to make sure that this is the proper strategy for you before you move forward. So that's the whole point. Is I'm not gonna make that determination. You're gonna have to bring in a third party.
So Brian, if I have a single family rental worth $300K, is this worth pursuing for me?
Again, I don't know what your specific scenario is. So I'd say, sure, give me a call. I'll work up the estimate for you. You could take it back to your tax preparer and have them look at it. From like a rough number standpoint, let's say that you have a 20% land allocation. So $300,000, so you have a $240,000 basis on that property. Let's say that we're able to accelerate between 10 to 20% of that property. So now you're up to $48,000 in depreciation that you could take year one to offset either active or passive income. And the nice thing about it is it doesn't go away. So if you don't use that this year, but you end up using it next year, the year after that, or the year after that, you'll just have that pool of depreciation sitting on your depreciation schedule that you can use. Because let's face it, this year you may not have a lot of income on that property because it's just getting up and running. But next year you knock it out of the park and you have a bunch of taxable income. Now that appreciation could wipe out all that income for maybe that year, years to come. So yeah, I would say for that individual investor, it's definitely worth looking at.
Side question on this note. So you're doing the depreciation of the 27 and a half years. Does this tack onto that? As in like, hey, I could use this 48. Can I break down the 48K or does it have to be used in one single year? How does that part work?
So no, you could push it forward. You could take the 100% bonus depreciation. And let's say you only needed $8,000 of it this year. You'd still have $40,000 that would roll the future years.
Okay, got you. So that makes a lot of sense. That's like awesome. I love this conversation, by the way. I'm a tax nerd about how to save money.
Now, what I don't recommend is if you called me and said, hey, I'm planning on selling the property in 2 years, I would say don't do the study. And the reason why is because whether you do a cost segregation study or not, you're going to have depreciation recapture. Meaning when you sell that property, they're going to figure out how much you sold it for, what your profit is, and you're going to have to pay back depreciation that you've taken on a majority of the components in the building. So you wouldn't want to do a cost segregation study on a property that you're planning on selling in the short term unless your tax preparer had given you a specific plan, meaning do a 1031 exchange, or you're going to sell the property and immediately buy another property. Well, if you do that, you need to make sure your timing's right because you don't want to sell the property in November, think you're going to find a property and close in November, December, and then all of a sudden it gets kicked to January, and then you get stuck with the tax bill for the prior tax year. So timing's everything on this.
Oh, for sure. I agree. Timing's really important. I love this conversation about that because how people, realize this cost segregation thing, and then how long would you need to own this property to not have to do the recourse on the deductions? Would you have to own 10, 20, 30 years, or is it, how does that work, that part?
So you're always going to have depreciation recapture. But some of the assets that, we're reclassifying, I mean, think about your carpet. The carpet that you installed today, it's not going to be worth very much in 5 years. It's just not. Same thing with your appliances. So the fair market value on your short life assets may have diminished. So there's real no gain on those assets, but you're still going to have gain on the straight line items. So depreciation recapture is just going to it's going to have to be factored in when you sell that property. And anytime you dispose of an asset, anytime you go to sell real estate, it is so critical that you bring your full advisory team in, including your tax preparer, so they can tell you what the implications are prior to you selling that property, because you're going to need to know if you need to do a 1031 exchange or acquire another property, or realize that you're going to have to pay taxes on the gain.
You worked on everything from single family homes to senior living facilities. Are there specific asset classes, multifamily, short-term rental, commercial, where cost segregation tends to deliver the most dramatic results?
Yeah, so every property is a little bit different. And, going back to what I said earlier, when we're doing a cost segregation study, what we're doing is we're going in and breaking the property up into its individual asset components. So if your property has heavy site improvements, that's a win. If you've got a swimming pool, we're both in Florida, that swimming pools cost $100,000 to put in now, $150,000 to put in. Even the pool cages are up to $35 per square foot. And if you have a 1,200 square foot pool cage, all of a sudden you're talking tens of thousands of dollars of a 15-year asset. So look for site improvements on the property. So it's not always the individual asset class, although there are some asset classes that are amazing. Gas stations, for example, 100% bonus eligible because it's all 15-year property. Now, there's a couple of pieces that you need to know about that, meaning if they've got a convenience store and I think it's greater than 50% of the sales go to the grocery, then all of a sudden it changes the calculation. But in general, I would say look for, properties that have a lot of short life assets. In Florida, another big one that we have that catches people is the IRS considers, tile flooring permanently attached to the foundation. So it's going to be a straight line depreciation item. But some of your LVP, your carpet, that's a 5-year asset. So, it's just really look at each individual property. I've got clients that call me all the time and have me run estimates on properties they're looking to purchase. And they may opt to buy one property over another just because of the amount of accelerated depreciation that it can generate.
Oh, wow. It definitely changes the buy box for some people.
Depending on what your goals are. But no matter what the depreciation is, the investment always has to make sense. It always has to pencil. Never buy something strictly for depreciation. That just doesn't make sense.
No. Can you share a real before and after example without naming the client that shows what kind of tax savings we are talking about?
Again, yeah, I mean, I could rattle off tons of them. It just depends on what you're looking for, short-term rentals.
Your most memorable one.
Well, let's look at somebody who buys $1 million Airbnb. So a pretty nice Airbnb.
Yeah.
They buy it fully furnished. Maybe they have $20 or maybe $50,000 in furniture in that $1 million. So the first thing that you're going to do is carve off $50,000 for furniture. That 50 grand right there is going to be a 5-year asset immediately. So that's $50,000 in the furniture. So then once you back out that $50,000, you have a basis of $950,000 on that property. Let's say you carve out a 20% land allocation. That's $760,000 basis. Then, let's say the Airbnb has a swimming pool. It's got like a resort style setup. It's got the paver patio, the paver driveway. It's, landscaped to the nines. All of a sudden, they might be at 35% in short life assets. So you figure on that one property, that's, what is that, $266,000 in short life assets. So all of a sudden, $1 million acquisition, year one, can spin off that $266,000 plus an additional $50,000 for the furniture. So $316,000 on one property. So now maybe they make that though. I mean, these short-term rentals can make a ton of money. So maybe it's making, $150,000 a year in, net income. So that's 2 years of income that they're basically offsetting.
Which is awesome. Hey, it's basically when you put your hands on like a triple net and as a tenant and the owner says, you know what, first 6 months is on us until you build out and everything. Same deal here. Basically, the IRS says, first 2 years is on us. You don't have to pay taxes on it as long as you do it right, which it makes, I think that from our conversation, Airbnb seemed like a jackpot for this. Like
Airbnbs, I'm doing a lot of RV parks. RV parks are so amazing because when you think of an RV park, you're literally renting a parking space.
Yes.
So everything else is site improvements. I mean, what a gold mine, so all of a sudden it's all 15-year property. It's all roads, signs, landscaping, improvements specifically to support the business, which is renting a parking space.
So when is the right time? I know you're probably going to say from the get-go, but when is the right time to implement cost segregation? Is there an ideal moment in the hold period of a property? Could you do it like, hey, I've owned this property for 5 years. We should do a cost segregation on it. I'm gonna keep holding it for the next 5 years because that's when, let's say, I have my properties in an opportunity zone. You have to hold it for 10 years to be tax exempt when you sell it. So I'd say, hey, I own it for 5. Let's do cost segregation in the middle, and then I have more write-offs afterwards.
So I always recommend doing the cost segregation study in the year you acquire the property because you don't have to go and file the Form 3115, a change of accounting method, and pull forward the missed depreciation. It's not a problem. We do tons of look-back studies, but it's better if you just set up your fixed asset schedule correctly in the beginning, but we'll still go back and do look-back studies. We're currently going back to 2017 and doing look-back studies. Some providers go back further. We just cut it off with the Tax Cuts and Jobs Act back in 2017 because the rules changed. But, to your point about opportunity zones are so amazing. So let's say you acquire a property in opportunity zone. You do a cost segregation study on it. You accelerate all of the short life assets. And then 10 years goes by and you get a step up in basis. Now you have your step up in basis. So the depreciation recapture is basically wiped out. So it's just opportunity zones are amazing. So yeah, it's such a great opportunity, and it's so impactful for the communities that you're investing in. There's such a it's a win for the investors. It's a win for the community. So yeah, so that's great that you invested in an opportunity zone. They're amazing.
Thank you. What is a look back study, and who should be considering one right now?
So let's say you acquired the property 3 years ago or 4 years ago, and you've been depreciating it straight line 27 and a half or 39 years all this time. I can go in and look at your most recent depreciation schedule, and my team will calculate your estimated benefit of your missed depreciation on those short life assets. So let's say that you had that, let's call it $150,000 or $200,000 in short life assets. We'll go and grab that depreciation and pull it forward to your current tax year. We just have to do a calculation that offsets the amount of depreciation you've already taken on it. But that's it's a calculation we do. It's called a 481A adjustment. So look back studies, it's a great opportunity for real estate investors who never heard of a cost segregation study. They can still take advantage of it.
That's awesome, man. We might have to talk after this because I know we're a straight line. We haven't done a cost segregation on it, and I have it in the opportunity zone. So this makes a lot of sense. I know it's only a fourplex, but still, we bought it for 142. It's worth about $500,000 right now.
So that's one of the things that we look at as, clients often ask if we could do the cost seg on the ARV or after repaired value or the fair market value. The answer is always no. It's always based on your cost basis. So we'd have to go off your original 144 less the land allocation, and we would pull that out of your depreciation schedule. Then we could work up the estimate. The benefit for you, though, because of that step up in basis after 10 years, is all of a sudden that spread between 144 to 550 or wherever it lands, that's gone. So that's not a taxable event in the future. So it's like the best thing ever. And people say, 10 years is 10 years, but think about real legacy wealth. All of a sudden, you don't have to sell this property. You could, pass it down to your kids, your family, and all of a sudden, it's a really great opportunity. So.
That's why it's called an opportunity zone. Let's talk about the combination play. How does cost segregation work together with bonus depreciation, and why is 2026 such a critical window for this?
Well, it was really with the Tax Cuts and Jobs Act originally in 2017 that put 100% bonus depreciation into play. And then it started to phase out and it started to phase down. And then with the One Big Beautiful Bill Act, it brought back 100% bonus depreciation in 2025. And now that we're in 2026, bonus depreciation is permanent. So you can take the short life assets. You just need to do the cost segregation study to identify what those assets are. How much of the property is the fencing, the sidewalks, the driveways, the carpet. So getting a proper detailed engineering study is critical in making sure that you're able to pull forward the 100% bonus depreciation.
That's awesome. So the short-term rental tax loophole is getting a lot of buzz right now. Can you break down what it actually is and why it is so powerful for the right investor?
Well, I'm not a big fan of the word loophole because you still have to make sure that you're hitting the different parts of the test, meaning you can't just buy an Airbnb. You just can't buy a restaurant and take, bonus depreciation on short life assets and have it offset your taxable income. But what you can do is if you materially participate in the Airbnb or the restaurant or the food truck or any other property that has a business use activity, if you're materially participating and you have other active income, you could potentially group the depreciation losses that we're providing and offset other W-2 income. So let's say you make $150,000 W-2 income, and then you have $50,000 in depreciation after doing the cost segregation study. Now you're taxed on $100,000.
Much better.
Let's say you make $150,000 in depreciation. So
yeah. What qualifies someone to use this? Is it based on material participation hours?
There's a number of items that they have to check in order to meet that box. And that's where I defer back to their individual tax preparer. We don't do taxes. We do cost segregation studies only. I do work with a number of tax providers across the country that I can always refer out, investor friendly CPAs. So they would really want to make sure that they're talking to their tax preparer to make sure that they can use it to offset either active income or passive income.
So, given that Central East Florida is a major Airbnb and VRBO market, Daytona Beach, Cocoa Beach, and the Space Coast, how should local investors be thinking about this?
They just need to ask their CPAs, or they could, give us a call or jump on our website and we'll work up the estimates. And then they could take it back to their tax preparer. Because if they don't, there's a very high likelihood that their tax preparer is just going to take it straight line depreciation. And more times than not, they're going to, I hate to say it, but they may not put it on their fixed asset schedule correctly. And then you also have to think about the land allocation piece that I talked about in the very beginning. We really want to look at that number to make sure that is an accurate or a reasonable land allocation.
There is also common misconception that real estate deductions can only offset real estate income. Can you set the record straight on that?
That's that active piece. So active income. So if you're, if it's an active role, then, it could offset active income if you're grouping it.
And is this where the real estate professional status comes into play? And what does someone need to do to qualify for that?
Yeah, so real estate professionals. So if you're a real estate professional, and I think it's a minimum of 750 hours that you're spending, in the real property business. And that doesn't mean you're a real estate agent. That means you're in the real property business, which is a very large umbrella, meaning you could build, you could remodel property. You just have to be in the real property business, and you have to do it for yourself or own. I think it's a minimum of 25% of the company. You could take your historically your passive losses from residential real estate and consider them active losses to help offset other active income that you have from your construction business, your real estate sales business. So real estate professional status is very powerful.
It is. I agree. As soon as I got my license and I learned about it, I was like, oh, this is awesome. So good to have this. So, Brian, before we get into the long game strategy, I want to do our Florida deal breakdown. This is where we take one real scenario and walk through exactly what the numbers look like. Let's say an investor in Central East Florida buys a short-term rental in Cocoa Beach, purchase price $450K. Walk me through what a cost segregation study could do for that investor from start to finish.
So we kind of did that a minute ago on a different calculation, but it's really similar. It's you take that 450 purchase price.
Yeah.
You have to back out a land allocation, again, a reasonable land allocation. Let's call it, again, depending on where you're at, if you're on the beach, it's going to be higher. If you're a little bit inland, it's going to be lower, but let's just call it 20%. So you'd have a $360,000 basis. So that's what you acquired the property for, the entire property, meaning all the landscaping, the swimming pool, the fence, the appliances, everything. Let's say we go in there and we're able to accelerate 24% of that $360,000. That's $86,400 in accelerated depreciation on one property.
Got you. And what's the cost of a study like that?
It depends on the scope of work. So small residential properties tend to start right around $895. So $895 for a small residential property. They go up from there because I've seen properties that are, $450,000 in Tennessee in their horse properties. So they've got outbuildings, they've got, arenas, they've got, acres and acres of fencing. So it's all based on the scope of work, but on, a small residential, you're typically at about $895 for a starting place. And then it just kind of goes up depending on the number of units, the number of site improvements. We just really have to look at it and see how long is it going to take our engineering team to, to do the construction cost estimating on this project. We're not using statistical sampling sets or any type of modeling. People ask about AI all the time. We were talking about it before we jumped on the call. We are absolutely using AI. It'd be like saying, hey, I'm doing all the math in my head. That's not the case. It's not on my iPhone either. It's on my calculator that I got 20 years ago in college, So, or God, longer than that. But we are absolutely using AI to assist in our studies, but these are not AI generated studies. I've got engineers that are, they're doing the construction cost estimating so that, if you're involved in an audit in 3 years because we accelerated 35 or 35, or let's call it 20%, who knows, doesn't even matter. You want to make sure that you have a defendable position. And I can say, hey, the reason why we gave this asset this value is because of, these reasons. So.
Got you. And how long before the study pays off for itself?
Well, if it doesn't, I always put right on the bottom of our estimate, I show you, if your effective tax rate is, between, 14 to 37%, I put the return. So if you're saving, if you're at that $86,000 and you're at a 24% marginal or effective tax rate, that's $20,000, $20,736 in dollar for dollar savings. And let's say you spent $1,000 on the study. Well, that's $19,000 in the black. So you're going to know before you move forward with the study. So that's part of getting that free estimate up front.
So real talk, when does cost segregation not make sense? I want to give our audience the full picture here.
You're retired, you're Social Security, you don't really have any taxable income. You have 1 or 2 rental properties that aren't generating any income. So, I've seen that a lot where, maybe you've got a property that's a rental income, but really your kids live in it. They're not actually paying you any income on it. Don't do the cost seg. There's no real benefit for you. If you're planning on selling the property in the next couple of years and you don't have a plan to do a 1031 exchange or buy another property, don't do the study. I'm not trying to sell anybody anything. It's one of these things that it's really, hey, here's an estimate of what the benefit is. Take it back to your advisory team and let them tell you if it makes sense to move forward with. But those are a couple of scenarios.
And what does a truly tax efficient real estate portfolio look like over a 10 to, let's say, 20-year horizon?
That's really making sure that you have a solid plan for the disposition of assets. I would say that I would defer that question back to your financial advisor or your tax preparer, but cost segregation is definitely part of it.
Got you. And someone is listening to this right now thinking, I need to look into this. What are the very first steps they should take? Do they start with their CPA or they come to someone like you first?
Just go to the website Cost Seg RX and reach out, and our team members will tell you exactly what we need to work up the estimate. That's the place to start.
And what kind of information do they need to bring to that first conversation? What does the process actually look like?
Yeah, we want to make it as easy as possible, meaning we don't want to give you a bunch of homework. But typically what we're going to ask for is a property address. If it's a same year purchase, we're going to ask for the closing statement. If you have an appraisal, that's always helpful. A detailed list of any improvements that you made to the property. So if you spent $25,000, furnishing it or, putting in appliances or new flooring, we want to know that. If it's a look back study, we're always going to ask for your most recent fixed asset schedule or depreciation schedule to see what you've already filed with the IRS.
And tell us about the complimentary benefit estimate you are offering through Cost Seg RX. What is that and how do listeners access it?
Yeah, so it's a bit of a heavy lift and my team's not always super happy with me that I have them go through this exercise for everybody that comes in. But, the mission of the company is to provide tax savings, accurate data, and personal service. And that's it, it's getting an estimate where we're actually putting our eyeballs on your property. We're looking at it on the, on Zillow or on, satellite images. And then we're going to, come up with the best estimate of what we think we're really going to find in accelerated depreciation. We'll work up a proposal with a breakdown of your estimate of benefit. And then we'll have our sales team record a Loom video explaining it. And then we'll send it out to you to review. So that's what it looks like.
So, rapid fire round. One tool or resource every real estate investor needs in 2026.
Wow, that's a hard one. I don't even know.
Cost Seg RX, guys. That's the
That's
answer.
it. Yeah, thank you. Thanks for answering the question. Cost Seg RX, guys. I already lost the rapid round.
Biggest myth about taxes and real estate investing.
Oh, I would say that, when it comes to cost segregation, that, if you have a small basis on a property, it's not worth looking at. I think everybody should take a look at the properties, because your appliances are never 27 and a half year property.
You host your own podcast. What is the one episode of the Real Estate Explainer every investor should listen to?
This is great because we were talking about opportunity zones. I just recorded a podcast on opportunity zones, and I just learned a ton of information. And that's why I host the Real Estate Explainer, is not because I know everything there is. It's because the folks that I bring on are, just a wealth of knowledge. So that was a great one, the opportunity zones.
Best piece of advice you ever received about money or investing?
I would say, it's not a today business. If anybody's trying to talk you into doing something right now, sit on it. Tell them no, walk away.
What does the real estate market look like from the tax strategy side right now? Opportunity or danger?
Opportunity, always, but it's always buy right. Don't get caught up in these, I've been there in, the early 2000s, or when things were just, boiling and frothing. Don't get too caught up. There's always going to be another deal. So especially if you're a real estate investor. Real estate investors aren't buying because they're emotionally driven. You're buying because, you're buying a business, and that business needs to make sense for you. So that's it. Don't get caught up in a, buying frenzy.
If you had to start over today with one property and $0 in prior knowledge, what is the first thing you would do?
A prior property?
One
I would
property.
say, yeah, I don't know. I mean, this is a tough one that I'll probably lose on because, again, every deal is so unique, and everybody's lives go through these different ups and downs. Real estate really needs to make sense for you when you're going to buy it. And I've seen people jump into the market because they were so caught up. Hey, I've got to buy a house. And then they bought a house for $1 million that went down to $850,000. They lost $150,000 on it. And then 6 months later, they sold it. They got divorced. Everything fell apart. Whereas if they just would have held on to that property for another 2 years, it would have been back up. So, it's just one of those things that every deal and everybody is so unique. Just make sure you're making your own decisions and you're not trying to chase what somebody else is doing.
For sure. I think you misunderstood the question a little bit. I think you would start at learning about how to do this. The question was basically, you would get one property and no knowledge. What would you do first? That was pretty much the question.
Oh, one property and no knowledge. Good. You guys can edit that last part out. Hey, so if I had one property and I had no knowledge, I think I would definitely follow the BRRRR strategy. I think that is such an excellent way to go.
That.
Yep,
Oh,
absolutely.
Yeah, that's a really good one. I would research and then find the BRRRR strategy and then use it.
Yeah, I mean, if you could buy that fourplex, live in one of the units, refinance it in 2 years, move out, make $5,000 a month on that property and acquire another one, and then do it again and do it again.
Yeah.
So, yeah.
Just keep going until you can buy one for yourself and keep BRRRRing other ones. Brian, this has been genuinely eye-opening. If there is one thing I want every investor listening to take away from today, it is this. The bigger risk in your portfolio may not be the market. It may be your tax strategy. And the good news is that it's completely fixable. Brian and his team at Cost Seg RX are offering listeners a complimentary benefit estimate. That means you can find out exactly how much accelerated depreciation your property could unlock at no cost to you. You have nothing to lose and potentially thousands or tens of thousands to gain. Head to CostSegRx.com to get started. You can also find Brian on LinkedIn and on his own podcast, The Real Estate Explainer. I will link everything in the show notes below. If this episode added value to your investing journey, do me a favor, subscribe to Real Estate Roundtable on YouTube, Apple Podcast, or Spotify, and leave us a review. Every review helps more investors in Central Florida find this show. Next week on the Real Estate Roundtable, stay tuned. Until then, I'm Lancelot Lenard. Keep building. Thank you for joining us on Sir Lancelot's Real Estate Roundtable, where we've unveiled the mysteries of real estate together. Remember, in this kingdom of possibilities, every dream home is just a discussion away. I can help your real estate dreams come true. Just call me at 786-449-7518. Until our next roundtable, may your ventures be prosperous and your homes be filled with love and joy. Farewell, fellow knights of real estate.